Let's take a look at Southwest Airlines. And in this video, we're going to go through the process for valuing a company. And the way we do it is we enter financial information into the model, and then the model will calculate the future free cash flows of the company. And then we're going to figure out a discount rate to apply to those cash flows. And then at the end, we'll have the intrinsic value of the stock. And we'll be able to compare that to the actual stock price and then see if it's a buy or a sell. Then we're going to look at the financial ratios of the company and compare it to its competitors. So Southwest Airlines is headquartered in Dallas, Texas, and it's the world's largest low-cost carrier. It has 60,000 employees, and it carries the most domestic passengers of any U.S. airline. Southwest does not use a hub and spoke system like most major airlines. It uses a point-to-point system. It's so much more beneficial to have a point-to-point system, as you can see in the top of the graph, as opposed to a hub and spoke system. See, in point-to-point, if you're flying from Vegas to New York, it's only one leg. So if there's ever a delay or a problem with a flight in this network, it only affects this flight and no other flights. Because the problem with the hub and spoke system, and the reason there's so many delays with airlines, is because the way they try to save money, and although it does save money in a perfect world, but we never live in a perfect world, what happens is this might be Dallas, Texas airport in the middle. So the New York flight goes to Dallas, the Chicago flight goes to Dallas, and the Miami flight goes to Dallas. And then on the second leg, some people go to Vegas, some people go to LA, and some people go to San Francisco. So it does save a lot of money, but the problem is if one of these legs is delayed, these other legs, although they're on time, they have to wait for this other leg to come in order to leave to their destinations. And this is a simplified model. It could get really tricky with a lot of legs and a lot of moving parts. So it creates, one flight can create delays to dozens of other flights. It has a trickle-down effect, and that is kind of inevitable that there's going to be at least one delay or two delays. There could be bad weather somewhere. I mean, there could be so many things that could happen. So that's why it's such a failed system. And the more successful airlines like JetBlue and Southwest have benefited from the point-to-point system. Also, Southwest hedges their fuel. So what they buy, they purchase futures contracts. And if the fuel price is low, I'll show you a chart. And it's low now. It goes to 2019. If it went to 2020, it would probably be even lower down here somewhere. So this is the price of airline fuel per gallon. They tend to pay lower than we pay. So if fuel was around here, the $2, $1.80, $1.45, what Southwest would do, and JetBlue, is they would buy futures contracts. They wouldn't get the actual fuel. They would just get the option to get the fuel later on, but they would pay a lower price now. Obviously, if the cost of fuel was $3.17, they wouldn't buy futures contracts because they know they wouldn't want to spend $3 on fuel when they know it's probably going to go down because it's at a peak. And there was a point when the airline was making more money on hedging fuel than they were on flying planes. There was a concern they were running an investment bank within the airline benefiting from fuel prices. Because if you purchase fuel down here for $1.15 and the price goes way up to here when you need the fuel, then you can buy the fuel for this price instead of this price. You save all that money. And if you didn't need the fuel Say you purchased 1,000,000 gallons of fuel around here, and by the time it got up here, you only needed 500,000 gallons of fuel. So what you do is you save on the 500,000 gallons because you need it. So you save like $1.50 a gallon, and then you sell the contracts out of the market. When you trade options, that's generally what people do. They don't actually take, and when they buy any type of option, whether it's fuel or gold, they don't actually exercise the option at the end and take the product. What they do is they buy it, and right before it expires, they sell the option for a profit if it's in the money. And they were making money on their futures contracts, which is really interesting. But that wasn't the intention, I don't believe. But let's get to the modeling of the deal. So the first step is we need the market cap, which is 22.1 billion. And then the stock price is 37.85. And now we need the free cash flows. If we go to Yahoo Finance, and I try to do all this in the video so you can see how to do a discounted cash flow model in case you want to replicate it. And or at least you know the inputs and where to get them from. So free cash flow is the cash flow that's left over after operating a business for the year. So if it's positive, that's a good sign. That means you're adding cash to the business, and they are positive, but most airlines are not positive. Net income on the income statement is the profit and loss for a given year. You could also get this information on a quarterly basis. I'm doing on a yearly basis since we're running this model, but if I was investing in this company, I would look at their most recent quarter financials. They may have already reported their first quarter 2020 financials. And last is revenue. And now the model calculated the future free cash flows of the company. Now we need to figure out the capital structure of the company so we know what to discount those cash flows by. Because everybody has a different capital structure. Their interest expense is $82 million. That's the interest they pay on their debt. And let's see how much debt they have. So current debt is due within 12 months at $819 million, and long-term debt due after 12 months is $1.8 billion. So they pay 3% interest on the debt. Interest is tax deductible. So let's get their tax rate. And the income before tax is $3 billion, and the income tax is $650 million. So they pay 22% of taxes. So the cost of the debt is 2.4% after taxes. Just like if you have a mortgage, the interest is tax deductible. At 11% of that capital structure is debt, which is pretty good. It's really good for an airline. Let's get the beta because we need to figure out the cost of equity. And beta is the volatility of the stock, 1.24. So that means the stock moves 1.24 times the market. So if the market goes up 1%, this stock will go up 1.24%. And if the stock market goes down 1%, this stock will go down 1.24%. So now the cost of equity is 11.84%, and the cost of debt is 2.4%. So equity is much more riskier than debt. As you can tell, it requires a higher rate of return because equity is riskier. In the event of a default, equity holders are paid after debt holders are paid. That's why it's more risky and it deserves a higher return. But when you combine these two numbers, you get a weighted average cost of capital of 10.8%, and that's what we're going to apply to the future cash flows. That's this company's credit score, so if you want to call it, that's the rate they need to use to apply to investment decisions to see if it's a good investment or not. Just like your credit score or your risk factor is your interest rate on your mortgage. If you got a 6% interest rate on your mortgage, you're probably a really bad creditor and you don't pay your bills on time. But if you got a 3% interest rate, you probably pay your bills on time, you've never been in bankruptcy, you're much less riskier. But that's a pretty good whack. especially for an airline. So we estimated the future free cash flows of the company, and then we're going to discount those cash flows back to today's dollars. And then we get a value of the company of $31 billion. And then we divide that by 584 million shares. That's how many shares they have. And they have an intrinsic stock price of $53. And it's trading at $38. So it's a buy. It's trading at a 29% discount. So let's look at historical. So it looks like it was trading at intrinsic for quite a while. So I'm much more comfortable with the model. In the beginning, when I built the model, I just used other people's models and kind of copied those. And as I've done over 100 deals, it seems like the model is getting really close to what is in real life. So it seems like the model has been really refined over the past couple of months. People don't always pay what things are worth. People pay based off of supply and demand. So people are, and when I say people, I mean investors, the investing community. They're not saying the stock is worth $55, $60 anymore. The market is saying it's worth $41. And a couple of weeks before that, they were saying it was worth $25. So it's really based on the supply and demand of the market. If people feel the future of the company is worth more than the current price of the company, they're going to buy the stock. If people feel the future of the company is worth less than what it's trading at, they're not going to buy the stock, or they're going to sell the stocks they currently have. So let's look at the financial ratios of the company, and let's get some more information from the balance sheet to do that. So we'll go back to the balance sheet. Let's get their current assets, $6 billion. The current liabilities of $9 billion. And the equity of $9.8 billion. And then the EBIT of $3 billion. Always make sure you're taking the right number. So current assets are assets that could be easily liquidated and turned into cash. Cash is a current asset. Accounts receivable, that's what people owe you. Inventory, and they have $6 billion of current assets. And you can't look at any number in a silo. You have to compare it. $6 billion, wow, that's a lot of money. But when you compare it to the current liabilities, it's not so great. Current liabilities is the current debt and accounts payable, and that's $9 billion. So they don't even have enough to fund their current operations. And I'm not surprised with all that's going on, but we could always delve into that. But let's just take the numbers as they are. Equity is the value of the company. That's total assets minus total liabilities. And that's just the value of the firm according to the balance sheet. And that's $9.8 billion. So that's a good sign. Their assets are $9.8 billion above their liabilities. So that means if the company was liquidated today, they would have $9.8 billion left over because they would sell the assets and use part of the money to pay off their liabilities. Operating earnings are $3 billion. So from operating their regular business, they made $3 billion. But there's other non-operational expenses like interest expense and taxes. So they don't have much expenses. Other airlines have tons of interest expense and maybe these other crazy expenses in there. But they look like they're pretty lean. So let's look at their ratios. Great PE ratio. I like under 15, 9.6. That's stock price over earnings per share. So that indicates it's a good value. Low PEPS, price over sales. I like to see under 2.2. That's great. A good price to book. I like to see under 3.3. They have 2.2. That's price of the stock over book value per share. Book value is your equity, and that's just equity over the number of shares outstanding. That's how you get your book value per share. Current ratio is a red flag. It's under 1. That indicates they can't afford to operate their day-to-day business with their current assets, and they would need to go into debt. But that's not a terrible sign because they only have 11% debt. If they had 80% debt, I would be concerned because they can't borrow much more. But they don't have a lot of debt, and they seem to be a strong airline according to its other ratios and financials. So I'm not terribly concerned with that. Strong ROE, they're providing value to their equity investors, 23%. So if you're investing in a company and they have an ROE of 10%, and there's another company with similar risk and an ROE of 20%, it's probably better off to invest in a 20% company, because if you're taking the same amount of risk, you'd rather get a higher return. An interest coverage ratio, this is important, especially for companies with tons of debt. They don't have a lot of debt, so they can cover their interest payment. The interest payment is the $82 million interest they paid on the debt. They could cover it 36 times. So if this was under 1, this would be a big problem, but they can easily cover it, and they don't have a lot of debt, which makes it a lot easier. So I'm going to compare LUV, Southwest, to 5 other airlines to see how they stack up. So for PE ratio, Delta has the best PE, and they all have good PEs. Mainly because the price of stock has gone down so much for all the airlines, so it makes the PE look better. But also stock buybacks have also helped the PE. But you could improve your PE by taking on lots of debt, because PE is just the price of stock over the earnings per share. So when you take on lots of debt, it doesn't really affect your earnings. I mean, you do have interest payments, but for the first few years, if you add a few $1 billion of debt, then you can use that money to maybe buy more airplanes or invest in your operations. And it looks really good in a short term. Eventually, it will catch up to you if you keep adding more and more debt. So you also have to look at the debt when you're looking at these things like PE or most ratios, for that fact. American has the best price over sales ratio of 0.2. But they all have a good ratio. That's just the nature of the airline business. JetBlue has the best price over book of 0.6. It looks like they all have a pretty good price over book, except American, because it has a negative book value. So that's why it's negative. And then, let's see, the current ratio, they're all in really bad shape, except for Save. They all can't afford to run their annual operations, their day-to-day operations. They don't have enough liquid assets just to get through the year. And it's not bad unless you have 75% debt like American Airlines. Then it's bad, because you can't just keep borrowing forever. Eventually you're not going to be able to borrow, because nobody's going to lend to you if you're all debt. But if you have low debt, like JetBlue or especially us, then it's not terrible. They'll get through it. That's just airlines. They're just inefficient, and they don't make a lot of money. That's just how it is. Delta has the best ROE of 31%. JetBlue has a weak ROE. And then for debt, which is one of the most important things for an airline at this point, Southwest is in the best shape with only 10%. Because you can have a great business, and it could even be profitable too. But if you run into a bad year, like coronavirus happens, and you have to close down all if you own restaurants, if you own 20 restaurants, and you have to close them all down for 6 months, just because you were making tons of money in the past doesn't mean you're going to be successful. Some businesses can't go 6 months with no money, or even 2 months with no money, unless you were really tight with money and you've been saving. But most people just don't do that. They live usually above their means. They get a nicer house, nicer cars, they go on nicer vacations, they treat themselves. They don't save for a rainy day, or they don't save enough. So they ended up going bankrupt because they just can't afford to pay their expenses without any income. So it's a lot to think about when investing in a company, and you should always think about it as an actual company, not a share of stock. And is the company providing cash profitability? And if they're not, then you should be concerned. But let me know what you think in the comments, and I appreciate you watching the video, and see you guys soon.